Okay, we are ready for the fifth lecture. I'm turning off the air conditioning, and we're going to finish up the nominal rate of interest today. And keep in mind, our purpose is to be able to analyze any rate under the sun, explain why it is as high as it is, why it's not higher, or why it's not lower than it is. And here we have a template or model, the deconstruction of the nominal rate of interest. And we know there are 5 components to the nominal rate. The first component is pure interest. Good estimate of that is 4.25%. Pure interest is supply and demand, if you will, are determined by the valuation of time preference. And the time preference rate of interest, sometimes it's called the pure rate, sometimes it's called the originary interest, even the risk-free rate of interest, but I prefer pure rate. It's easier to say. By the way, one of our greatest economists really made a contribution in in theory, the perfection of the time preference rate of interest. Irving Fisher, probably the most famous American economist ever. And he was a professor at Yale, and then made other contributions as well. So anyway, what do we want to say here? We have the pure rate of interest. We have the debtor's risk premium, which is a default premium reflecting trustworthiness and economic soundness. It is collected as the automobile insurance premium. Lenders make bad loans, and entrepreneurs engage in bad loans or are willing to participate in bad loans. What do we want to say here? The third component is the inflationary or deflationary price premium. And we're used to a world of inflation, but we can have a deflationary price premium. In the last 35 years of the 19th century, there was a deflation of prices averaging 2.2, 2.5%, depending on what year you chose as the base year. And this would, of course, be a negative number. And then our best estimate there of a inflationary price premium is 2.1%. Some people may quibble with that. Maybe it should be 1.6, 1.8. The estimate for a 3-month Treasury bill for the debtor's risk premium is 25 basis points, or 1/4 of 1%. So if you add all 3 of those together, you get 6.6% nominal rate of interest. And then for today's lecture, we want to consider the 4th and the 5th factors. And here, everybody, the liquidity premium is very interesting to study, but it is probably the least significant. A good estimate of it is 15 basis points, and it's a negative number to boot. And I'll explain why it's a negative number shortly. But we want to start out in the explanation of it as making reference to the marketability of money. Money is the most marketable good in the U.S. economy. The U.S. dollar is. And really, the U.S. dollar is the most marketable good in the whole world. Various currencies that is thought would compete with it, like the euro, but hasn't happened. The dollar is acceptable in the Eurozone, but the euro is not acceptable in the United States or in North America. So we want to contrast that with certain other goods that are highly, highly marketable. So marketable that we will give them a category name, goods of secondary marketability. Not nearly as marketable as money, but certainly highly marketable, easily bought, easily sold. And, you know, marketability is one meaning of the word liquidity. There are two other definitions of liquidity that we should learn later on, of course. So I don't know what happened to the picture here. Let's see if we can bring it back. Goodness. There we are. Sorry about that. That's my fault. But anyway, these goods are so marketable that they permit one to take advantage of their marketability and reduce one's demand for money, reduce the, if you will, the amount of cash you have on your person in your checking account. You can have surplus funds, everybody. And especially as you get older, if say you're in the finance sector, you start to get really high salaries, you have these surplus funds, and so what are you going to do with them? With surplus funds, you're indifferent when to utilize them, and you know you may have a great big amount of money in your checking account or even on your person, and what I'm about to tell you about is something we call cash management. Because of the existence of goods of secondary marketability, you can manage the level of your cash holdings. You can reduce them, if you will, and invest in these goods of secondary marketability. And then if an emergency arises, then of course you can sell them very easily. Marketability means ease of buying, ease of selling. And so what are some of these goods? Well, interest-bearing securities, you'd have in the United States 3-month and 6-month treasury bills. You also have in the United States, you have the precious metals, gold, silver, and platinum. You have the precious gems, diamonds, rubies, emeralds, sapphires, and topazes. But you must be careful when you buy gems. There's a time to buy them and a time not to. So be careful there. We have repos, repurchase agreements, if you will, and really what are involved are bundles of treasury bills or treasury securities. And you can have repos with corporate securities. There are other goods of secondary marketability as well. We have the 10-year German Bund. They don't all have to be short-term instruments, by the way. It's the enhanced marketability, which is so attractive, which permits you to reduce the level of your cash holdings and thereby make better provision for the future. You earn the interest income off of interest-bearing securities for as long as you hold them, and possible capital gains with the gold and the gems and other instruments. We have certain certificates of deposit, big certificates of deposit now that are very marketable, and I'm sure I've left out a few, but point is, because of their very existence, one is able to reduce the level of surplus funds, cash holdings, and benefit either with the interest income or with the capital gain. And you can do this because these goods are so very, very marketable. And there are other thoughts associated with the goods of secondary marketability, but when we look at the 3- and 6-month treasuries, we want to say that those who are have participated in the government securities market, especially at the short end, know that the nominal rate of interest there, which is called the rate of discount for these two instruments, it is less than comparable instruments of goods of the same maturity, but not as marketable. What are we saying here? Well, if we go back to the first time that people took advantage of the marketability of, say, a 3-month or 6-month treasury bill. What they did was reduce their cash holdings by investing, if you will, in the 3-month or 6-month. And that, of course, increases the price, other things being equal. But we know there's always an inverse relationship between the interest rate and the price of a security. And so if the price of a 3-month treasury bill increases, the yield or interest rate, or what is called the rate of discount in the marketplace, decreases because of this inverse relationship. So don't you see the drop in yield gives you the negative number. Now, casual empiricism, it's my casual empiricism of how large the liquidity premium runs, or how big it is I would say, again, casual empiricism, 10 to 20 basis points, but it's a negative number. And so what I do is split the difference, 15 basis points. And I add on negative 15 basis points to our sum of 6.6%, which is the sum of the inflationary price premium plus the debtor's risk premium plus pure interest. So if you add in the liquidity premium, you get 6.45%. And that's the sum of the first 4 numbers. And therefore, we have what is called the natural rate of interest. It's a concept given to us by the Swedish economist Knut Wicksell, a very seminal thinker, Swedish economist, back around the turn of the century of the 19th into the 20th. And he came up with the natural rate concept. And what he's really saying is this is the rate of interest which the market would arrive at without the intervention of central banks and anybody else. So the natural rate of interest today is, my estimate, 6.45%. And of course, the actual rate is below 1%, really below 0.5%, below 50 basis points. I think it's around 38, 40 points. I'd have to check. I haven't checked it in about a month. But it's extremely low. So I want to say to you that this low rate, it's certainly not the natural rate. It's not what the market would establish. And indeed, you should know that market rates in U.S. government securities right now, especially in the short end, are not determined by supply and demand. They're dictated to or imposed upon the private sector by the Treasury and the central bank. Market dealers are told to offer funds or buy and sell at extremely low levels. And of course, if you're supplying funds to the government, the rate seems very, very low. But if you're buying these treasury bills, selling the treasury bills, you get a high price. And anyway, enough of that. But the market price is really dictated by the market dealers who are told what to do by the Fed and the Treasury. So we have these low rates, and the natural rate, 6.45%, also almost seems unimportant or unreal. But everybody, this is what the market rate should be. We have extremely low interest rates, and these extremely low interest rates mean that we have financial repression. And there's no incentive really to save because rates are so low. Many times, and you can verify this with any number of people, we're not all financial whizzes. And so, if we have surplus funds, many people open up a savings account and earn the 4, 5, 6%, but that's not possible anymore. And so it's no incentive to save, and it's really a shame. And because of this easy monetary policy, we're putting up with that very fact. But it tells you that something is wrong. Something is really, really irregular, that rates are so low and remain so low when we know that the natural rate is approximately now, this is an estimate, 6.45%. A way to get it, what we're talking about is to take the following example. It's a hypothetical example, but and contrived, but it makes the point. Springtime comes around. It's before the coronavirus pandemic, and 3 or 4 young men go to the up to Park Avenue around 51st Street, 52nd Street. I guess they want to go to the Ferrari dealer to see the latest Ferrari cars. And as you know, the sidewalks on Park Avenue are very wide. And so it's springtime, and the 4 gentlemen are having a good time. They're college students, Baruch College students, let's say. And what happens? One of them doesn't look where he is going, where he is walking. He trips over a fire hydrant and breaks his leg. So his buddies take him to a doctor on Park Avenue. The doctor on Park Avenue finds out they are students, Baruch College. He knows that some students have beat him out of money for his services in times past. So he says to the person with the broken leg, I'm not going to fix your leg unless you pay in cash. And so our friend, he can't borrow money from his buddies. They don't have enough. So what does he do? He calls up his broker. He bought some treasury bills around 11 o'clock in the morning. It's now about 1 o'clock in the afternoon. And he orders the broker to do what? To sell a fraction of the treasury bills that he bought, turn it into cash, and either with a cashier's check or with actual cash, send a courier up to the doctor's office to make payment. And that's exactly what happened, because the treasury bills were easily bought and also easily sold. An emergency came up, and therefore the doctor was paid and the broken leg was fixed. Well, yes, it's very contrived, but you get the idea. There are goods of secondary marketability, not nearly as marketable as money, as is the US dollar, but still extremely marketable. And you can engage in an exercise in cash management. You can reduce the level of your surplus funds and thereby make greater provision for the future. You receive the interest income for as long as you hold the securities off goods of secondary marketability, interest-bearing securities, or you would wait for a capital gain for owning gems or gold or whatever. So there you have it. You talk about a lot of other things connected with the liquidity premium. It's very interesting to consider all this stuff, but we'll stop there. So now the 5th component is to account for the monetary policy actions of the central bank. And I'm here to tell you that for the last roughly 120 years, we have had not quite that amount. There have been intervening times where we haven't had easy money, but many of those years have been under a regime of easy money. Not as easy as we have today, but easy money is what did away with the gold standard. Too many so-called money substitutes were created. And at some point in 1971, we didn't have enough gold, and therefore we shut the gold window, and we wind up with the fiat money we have today. So what do we want to say here? monetary policy of the Federal Reserve has been over many, many decades to uh, to do what? To lower interest rates so as to give businessmen and women incentive to undertake more loans and therefore undertake an expansion of production. One definition of the boom of the business cycle is the attempt to expand production and of all prices to rise. And we get of all prices to rise from the increasing money supply. And we'll discuss that shortly here soon. The 4 cases of the quantity theory of money. So we want to wind up this lecture by pointing out that at various times in our recent history, the components have differed in their significance or importance. For example, in the late 1970s, with high single then double-digit inflation, it was the inflationary price premium that became the dominant factor. We had roughly a 14% inflation in 1979. Add that to 4.5% pure rate plus debtor's risk premium plus liquidity premium, but add 1400 basis points for the inflation of prices, and the 3-month Treasury bill traded between 18.5% and 22.5%. Simply amazing. This is short term. Now, that was at the end of the 1970s. Inflation was a dirty word, especially to your parents and grandparents, especially. Then in the Great Recession, 2007, 2009, it was the easy monetary policy that we have today, which is the most important factor, and also the debtor's risk premium. And I think I told you before about the Greek 10-year bond. It went up to real fast to 37.5% because many people doubted the solvency of the Greek government. Well, things got straightened out, and now it's down around 6%. In normal times, without heavy-duty inflation, without heavy-duty bankruptcies and insolvencies, it's the pure rate that accounts for most of the height of the nominal rate of interest. But in other times, we have the debtor's risk premium. It's especially true with the Great Depression as well. And so these other items, if you will, of the nominal rate of interest vary in their importance as we go from one episode to another. And keep in mind, money is non-neutral. It is it causes the business cycle. It causes inflation. And well, Bob's your uncle. So there we have it. The one thing I haven't touched upon is the real rate of interest, and that's defined nothing more as the nominal rate less an inflationary price premium. If you were to choose the 3-month Treasury bill rate today and use 2.1%, the real rate of interest would be a negative number. And many economists say, well, they prefer to talk in terms of real rates, but it just is easier to talk in terms of nominal rates, and to, if you have to make an adjustment, talk about the inflationary price premium. So, so today we have a regime of record low interest rates brought about by the central bank and with the help of the Treasury and the politicians, of course. It's what they're doing is, in many ways, buying votes with the low interest. But you know, everybody, the recurrence of the business cycle has become very severe, especially here in the 21st century. our downturns have been much more severe in the 21st century than the post-depression years, really post-World War II years, when you've had busts in the business cycle. We've realized, we have learned that the bust can be extremely severe with the dot-com bubble bursting, and also the Great Recession. It took a good while to recover from the dot-com bubble bursting, and we still haven't fully recovered from the Great Recession. We still have some problems arising from it. And then everybody, right now, our easy monetary policy is conducted, yes, because we have a coronavirus bust. Many profitable and marginally profitable firms became submarginally profitable. And so therefore, a lot of US corporations are they were illiquid and possibly insolvent. And then there's another factor besides the coronavirus bust contributing to this state of affairs. It is the debt issuing binge of US corporations from 2010 to 2020, right up to the present. Back in 2010, total corporate debt was $48 trillion. In 2019, total corporate debt was an eye-blinding $75 trillion. So corporations have had very little incentive to save and self-finance their own expansion. Why? Because the monetary policy has been so easy. Interest rates have been so low, there's very little incentive to save oneself, and why not borrow the funds? So we are sitting on a possible cause of a new financial crisis. The characteristic feature of a financial crisis is the destruction or near destruction of the finance sector. In other words, in 2007, 2009, we all came very close to jumping off a cliff, in which American citizens, strange though it may seem, could be denied access to the money and capital markets of this world. If it had actually happened, if the finance sector was destroyed, then if you want a car loan, you wouldn't be able to get one, or a house loan, wouldn't be able to get one, or a business loan, no way, you wouldn't be able to get one. So, third world countries are used to have, their populations don't have access to the money and capital markets of this world, but a life-changing occurrence would happen if the finance sector was destroyed. So we have the two worst disequilibria that an economy can face, that mankind can experience. Not economic disequilibria now, not other things. Number one, the second worst would be a financial crisis. And we've gone through that. And again, the characteristic feature is a lot of, the near destruction of the finance sector, and there's tremendous capital consumption that occurs at the same time. Then this, and we know a lot about that now, having experienced a financial crisis. But then we also have another disequilibrium that mankind can experience. This is the worst of all worlds, is a disequilibrium called the demonetization. Money, the value of money goes to zero. And so you won't go to work because you'll be paid in worthless banknotes or checks. And therefore production tends to cease. Producers would be paid in worthless banknotes or checks as well by their clients, so they don't produce. And if production stops, then consumption soon follows. So the rate of unemployment in a demonetization tends toward 100%. And civilization as we know it disappears and is replaced by the law of the jungle. The worst of humanity shows itself. And of course, the demonetization, historically speaking, that everybody points to is the German demonetization in 1923 of the Reichsmark. For 6 months, Germany experienced the worst of mankind. Law of the jungle prevailed and almost prevailed in 1946 after World War II. Again, and the Germans are probably the most important backers of what is called sound money to restrict the flow of new money and be mindful of inflation. So the rate of inflation went toward infinity, but more importantly, the division of labor disintegrated. So that's why demonetization is the worst of all economic disequilibria that can befall mankind. So there you have it, tonight's lecture. I have one more joke for you, and I hope you all are going to mail me some jokes. My email address is william.henry@baruch.cuny.edu. What does the word 10-4 mean? Well, police can tell you what they mean by it, of course, but the meaning that is supposed to be a joke is that there's a big man and a small man, and how do they divide up $14? Big man gets $10, the small man gets $4, $14. So anyway, okay, thank you very much, and I may come back later this evening with another lecture. So this is lecture number 5. It's July 20th, and it's around 7 o'clock right now in the evening. Thank you very much. And we'll try to end the meeting.